Spring is off to a wintry start on the share market, and the only reason for this seems to be that it's September, which is historically the worst month for shares. Last month got off to a similar start. After falling 6% in a couple of days at the start of August, the market spent the rest of the month getting back to where it was at the end of July, only to hit another snake in the eternal game of snakes and ladders that is the share market, and drop 2% today. There was red ink everywhere, with falls of more than 2% among the miners, banks and retailers, especially Fortescue, which went ex-dividend. And that followed a 2% drop on Wall Street, with Nasdaq down more than 3% and the Nikkei in Tokyo down more than 4% today. And it also followed big falls on commodity markets. Oil was down more than 5%, iron ore 3%, copper 2.5%. Now, when oil falls like that, with a lot of geopolitical risks around, you know that global demand is very weak. The Aussie dollar fell to 67 US cents flat, but that had nothing to do with the GDP numbers. It was down when the data came out. Now, some GDP graphs. As predicted last night, GDP per capita fell for the 6th quarter in a row. It's a long per person or per family recession. But look at the long-term trend. It's inexorably down. It's because real household income per capita is going backwards. It's down 2% over the past year. So immigration is holding up the aggregates, which we knew already. So is government spending, now at an equal record high as a share of the economy. And finally, here's Australia's June quarter economic growth compared to Europe, Canada, UK, US and Japan. We're not on the podium, we're last. And that's finance.